This is Nightly Business Report with Sue Herrera and Bill Griffin.
Stock rout. The Dow tumbles 600 points to start the week as the wave of selling spread from one sector to the next.
Tech wreck. Apple tanks and brings the rest of the sector down with it. What will it take for tech to regain its footing, and what happens if it doesn't?
California burning. Fires are spreading, cost estimates are rising, and state utilities are coming under scrutiny. Those stories and much more tonight on Nightly Business Report for this Monday, November the 12th.
Good evening, everyone, and welcome. It was an ugly day on Wall Street. Stocks fell hard, led lower by a sell-off in technology. But there was more to it, a lot more. The declines quickly spread throughout the market, and the end result was a broad sell-off that took down just about everything. Let's get right to the final numbers for you. The Dow Jones Industrial Average slid 602 points to 25,387. The Nasdaq was down 206 points, or 2.8%, and the S&P 500 fell 54. Bob Pisani reports from the center of it all at the New York Stock Exchange.
It was a sea of red today on Wall Street, with the Dow plunging more than 600 points at the close. The market's boxed in because of worries about global growth and the Federal Reserve. That's the principal problem. Today's decline in tech can't be blamed exclusively on Apple. There was a supplier, Lumentum, one of their facial recognition suppliers, that reduced their outlook for the quarter. They cited reduced shipment requests from one of their biggest customers. Everybody assumed that was Apple, but that's not the only problem. FANG names like Facebook and Amazon were down 2 to 3%, and the industrial and energy sectors were down 1.5% each, pointing to a big problem. U.S. growth seems strong, that's good news, but the global growth picture in Europe and China is generally weaker. Another problem is the strong dollar, with the Fed raising rates, worries about Italy, the UK, leading to a weak euro, China's slowdown concerns, that's all pushing the dollar up. And the dollar, in turn, is hurting commodities. There's been double-digit declines this year in copper and in aluminum and zinc and lumber. Again, global slowdown. This recent decline in oil we've seen, it's being blamed on oversupply issues, but concerns about a slowdown in demand are also a factor. So the bottom line is this: there's lots of questions about global growth and what the Fed's going to do in 2019. For Nightly Business Report, I'm Bob Pisani at the New York Stock Exchange.
Bob just mentioned Apple, which got a lot of attention today from investors. The stock fell 5%, making it one of the worst performers among the Dow 30 components. Josh Lipton takes a closer look now at why there is so much focus right now on the largest U.S. publicly traded company.
Worth nearly $1 trillion, Apple is the most valuable public company in the world. But today, its stock got whacked on news from one of its pint-sized suppliers. Lumentum slashed its second quarter forecast, saying that a large customer cut orders. Now, it didn't name that customer, but investors drew their own conclusions, as the small laser maker's technology enables the iPhone's Face ID feature, and that caused new worries about the health of Apple's bread and butter, its iPhone franchise. In the past, Apple CEO Tim Cook has emphasized that his supply chain is big and complex. His point is that it's hard to extrapolate trends from just a handful of data points. In other words, it's not just Lumentum, that Apple relies on other companies too, like Finisar and II-VI, which recently announced a merger. Analysts estimate those two companies account for about 50% of this critical laser technology to Apple. Both companies also traded lower today. Still, the bears came out in force today, saying this news reinforces their view that iPhone shipments are declining. Even bulls on Apple, like J.P. Morgan, are now forecasting year-over-year declines in iPhone shipments. On the other hand, Citi's Jim Suva says this Lumentum news is a concern, but he was never counting on a big jump in iPhone units anyway in the quarters ahead. He's more focused on how much money Apple is making on each phone that it sells.
We believe that the average selling prices are going to be much bigger than expected. And with that comes the opportunity to have more profitability. Now, the cost of goods sold, or the memory costs, known as NAND and DRAM going into it, keep falling. That means on the same given unit, Apple's going to make more and more profits to drive more revenues and EPS and cash flows.
That bullish view was in short supply today, however, and it's been a tough couple weeks for Apple. Since the iPhone maker last reported earnings results on November 1st, its stock is down more than 10%. For Nightly Business Report, I'm Josh Lipton, San Francisco.
It's not just Apple. Investors are also concerned about the threat of potential regulation on internet companies, something we've been telling you about. And that's just one of the concerns that drove media stocks lower today. Julia Borston picks up the story from there.
Social stocks struggling today as investors continue to question the long-term potential of platforms whose user growth is stagnating. Snap shares ending the day down over 2%. Today, the company losing yet another senior executive, VP of Content Nick Bell. He oversaw all of the partnerships Snap has with media companies, which have fueled the growth of Snapchat's Discover section. Bell is just the latest in a series of executive departures and changes at the top. And Facebook shares losing nearly 2.5%. The company saying it's partnering with France for a 6-month investigation into hate speech on the platform and how to prevent it. Veteran investor Ann Winblad saying this is just one of Facebook's myriad challenges.
Facebook is another story. I mean, Facebook has trust issues. We've talked about that in the past. They have saturation. They have revenue per user issues. And they can't seem to come up with an encore. Either to their trust issues or to products themselves.
And Twitter also facing concerns about the spread of fake news and hate speech. Its shares losing 6%, giving up some of its gains following its earnings report last month. For Nightly Business Report, I'm Julia Borston in Los Angeles.
Let's turn to Paul Meeks right now to get more on the technology sell-off and what it means for the overall market. Paul, of course, is lead portfolio manager at the Wireless Fund. Welcome back.
Great to see you.
How much longer do you think this lasts? And what are you watching to tell you how much longer you think it'll last?
Excellent questions. I think that we're not near the trough, but maybe we're getting within a quarter or two of a potential bottom in the tech sector. You know, one of the things that most average investors don't realize about the tech sector is it's highly cyclical. And when you take a look at the U.S. markets, you know, the U.S. markets are divided into 11 economic sectors, technology being just one. It is a 20% weight of the market. So a very big influence, a cyclical market, and there are concerns, not about U.S. growth, but about growth abroad.
Yeah.
The tell that I'm looking for in technology is kind of interesting. A big portion of technology is the semiconductor industry. And what we're hearing from a number of the major semiconductor companies is that their companies have, or their customers, have too much inventory of chips. We call that in the industry an inventory correction. And when we get some semblance of a balance and the customers start drawing back that inventory and they start ordering again, that is the biggest tell for a turnaround in the fortunes of the tech companies in these stocks.
You also say that you need to at least see some progress or change or development in the U.S.-China trade negotiations.
Yes, this is a very significant issue, and some of the leading forecasters, particularly in China, think this might be a problem that lasts for several years. In the meantime, I'm chomping at the bit to buy shares of some of the leading internet companies in China, like Alibaba, that just posted monster sales on their Singles Day over the weekend, but I can't really step in until we clear up some of this geopolitical mess.
Before we let you go, Paul, very quickly, some of the opportunities you see, we just showed them on screen here, companies like Boeing and Visa and MasterCard. Why those?
Interesting. I want to play some defense. And I think particularly payments processors a la Visa and MasterCard are good, relatively defensive tech plays, and I do consider them tech stocks. Also, Boeing is very interesting because the most captivating part of Boeing's story, in my view, is not the assembly of aircraft. It's their services business, which is very high tech, very high margin. I can hide in some of those companies until the smoke clears with the rest of tech. And of course, I already have a relatively high proportion of cash to keep some powder dry for better opportunities.
Very good. Paul Meeks with the Wireless Fund. Always good to see you. Thanks again for joining us tonight.
Thank you.
Goldman Sachs saw its worst one-day drop in about 7 years. The sell-off follows a report that former CEO Lloyd Blankfein was the unidentified high-ranking executive referenced in court documents related to a 2009 meeting with the former Prime Minister of Malaysia, who was involved in the 1MDB scandal. The stock fell more than 7% in trading today.
Meantime, shares of GE fell below $8 a share today, its lowest level in nearly a decade. During a wide-ranging interview today, the company's new CEO said that he's focused on bringing down the company's debt levels.
We need to bring the leverage down, and I think we've got plenty of opportunities through asset sales to do that. In the last 6 weeks, this is my mark 6 weeks on the job, I've heard from lots of people across our markets, people who have interest in GE assets. And I think that's confirmation that we have quality franchises and, frankly, that we have options.
Mr. Culp emphasized that he will not rush this process, even though he is feeling pressure to move quickly. He also said that GE has no plans to raise additional equity in the stock market. He thinks the power business is getting close to bottoming out, and he's looking to streamline GE's corporate structure in order to save money. The stock today closed at $7.99.
Oil prices, which started the day higher, settled below $60 a barrel. Domestic crude marked a record 11th straight session decline, and it follows weekend discussions by major oil producers to potentially cut production.
Time to take a look now at some of today's upgrades and downgrades. We begin with some airline stocks. JetBlue and American Airlines initiated with a buy rating in new coverage at Goldman Sachs. In general, the analyst expects the airlines to report strong revenue next year. The firm also sees a bigger focus on cost controls. Shares of JetBlue fell a fraction today to $17.99. American Airlines shares rose more than 1% to $36.86. L Brands was upgraded to outperform from market perform at Wells Fargo. The analyst sees L Brands as the next retail turnaround story. Price target now $55. Shares rose 1% to $37.02.
Starbucks was upgraded to buy from hold at Argus Research. The analyst cites the potential for continued revenue growth, new store openings, stock buybacks, and dividend increases. The price target is $79, but the shares fell in an overall down market by 1% to $67.91. Cheesecake Factory was downgraded to underweight from equal weight at Barclays. The firm cites headwinds and the stock's valuation. The price target is $47, and shares of Cheesecake Factory fell 4% to $50.15.
Still ahead, California scorched and the cost is climbing. Well, the California wildfires are still spreading, and only a small portion has been contained so far. Fires are being whipped by strong winds, burning thousands of acres of land, homes, businesses on both the northern and southern part of the state. And tonight, state utilities are in focus. Aditi Roy is in Southern California, Camarillo, for us tonight.
California is burning on both ends, with wildfires ravaging northern and southern California. Up north, the Camp Fire is now the most destructive fire in California history, decimating an entire town called Paradise.
It was a beautiful place.
The Camp Fire also matched the record for the deadliest fire in the state's history. Between this blaze and Southern California's Woolsey Fire, the two infernos have scorched more than 200,000 acres, destroyed nearly 7,000 homes, and evacuated 250,000 people.
I was just coming up the street to see my neighbors, and I didn't realize my house gone too.
Beyond the tragedy of the lives lost, homeowners are also bracing for damage estimates. CoreLogic says the total reconstruction value of the more than 48,000 homes in extreme or high danger in the two fires is about $18 billion. And Zillow reporting that the nearly 22,000 homes in the Woolsey and smaller Hill Fire in Thousand Oaks, California, have a combined value of $42 billion. According to one estimate, in 2017, home and farm insurers lost $16 billion, quadrupled from the previous year. Some industry insiders say that could result in a slow creep in fire insurance premiums in some areas. Meantime, 2 California utilities say they suffered outages minutes before the fires started, their stocks falling sharply on the scrutiny as concerns mount that the companies could face billions of dollars in potential liabilities. This as firefighters brace for yet another day, battling fierce flames fueled by high winds.
It's just a roar. It's a roar in your ears that you'll never forget.
As homeowners wait and watch nervously, we also know that Travelers Insurance, in its last earnings call, had also warned investors about upcoming wildfire payouts, and that was before these November wildfires. For Nightly Business Report, I'm Aditi Roy, Camarillo, California.
A deal-making Monday. That's where we begin tonight's market focus. SAP, is buying the software firm Qualtrics for $8 billion. The head of SAP says the acquisition will bolster that company's offerings. Qualtrics had filed for an initial public offering last month, hoping to raise about $200 million. SAP shares fell more than 6% to 101.42. And another software deal to tell you about. Aptio is being taken private by Vista Equity Partners for nearly $2 billion, just 2 years after it went public. Aptio helps companies manage and understand their cloud spending. Shares popped more than 51% in an otherwise sharply down market to finish at $37.65. Athena Health is being acquired for $5.5 billion by 2 private equity firms, Veritas Capital and Elliott Management. Athena Health announced in June that its board was going to start considering strategic alternatives around the same time its founder, Jonathan Bush, stepped down as CEO. Shares of Athena Health rose more than 9% to $131.97.
A Wall Street Journal report that the FDA wants to ban the sale of menthol cigarettes sent shares of tobacco companies lower today. Menthols represent about 55% of British American Tobacco's U.S. sales by volume and about 20% of Altria's cigarette sales. Altria shares were down 3.5% today to 61.20. Shares of British American Tobacco were down 8% to 38.08. And a strike has been avoided at UPS Freight after the company reached a deal that covers more than 11,000 workers and prevents what would have been that company's first work stoppage since 1997. Last month, UPS's small package division, which employs more than 240,000 workers, also reached a tentative labor agreement. UPS shares fell more than 1.5% today to 107.72. And Kellogg said late today that it is looking to sell its Keebler, Famous Amos, and fruit snacks businesses, all in an effort to focus on its core products in North America. Kellogg will consolidate its breakfast, snacks, and frozen foods units into one. The stock was halted late today. It finished the regular session down 1% to 64.30.
Lawmakers will return to Capitol Hill this week for their final session of the year. They're expected to tackle a number of issues that could determine whether a partial government shutdown can be avoided next month. Elon Mui has the roadmap for investors.
It's back to work in Washington as Congress returns to Capitol Hill tomorrow. There is still a lot to do in the lame duck session. House Democrats pick their leadership this week, and so far, no one is challenging Nancy Pelosi for the top job. After Thanksgiving, House Republicans will elect their party leaders. California Congressman Kevin McCarthy is expected to win, but he's fending off a challenge from the right by Ohio Congressman Jim Jordan. And with December comes another deadline to keep the government running. About 25% is still not fully funded, and there are some serious sticking points in the negotiations. Democrats want the spending bill to include protections for special counsel Bob Mueller and his investigation into Russian meddling in the presidential election. Meanwhile, Republicans want money for the border wall. McCarthy sponsored a bill that would give the White House the full $25 billion. Keeping the government open will require compromise from both parties, and the incoming freshmen in Congress say that's their goal as well.
We need people of integrity on both sides of the aisle. We're never going to be a one-party country. That's not our history. That's not how we work best. So I will be looking for anyone I can work with across the aisle, including in my own Michigan delegation, to get some real work done.
We'll see how long this bipartisan spirit can last. For Nightly Business Report, I'm Ilan Mui in Washington.
Some sad news to share with you tonight. A powerhouse of the superhero business has died. Marvel Comics legend Stan Lee was credited with revolutionizing the comic book industry. He created some of the most well-known superheroes of the 20th century, including Spider-Man, the X-Men, Iron Man, and Thor. His work as a writer, editor, publisher, and Hollywood executive helped make Marvel an international success. That company was purchased by Disney back in 2009 for $4 billion. Stan Lee, himself a real-life superhero to the comic book industry, was 95.
Here's a look at what to watch for tomorrow. We'll see how rising mortgage rates and slowing housing growth is impacting Home Depot when it reports its earnings. OPEC's monthly report will be in focus given the slide in oil prices. And we'll find out how small businesses are coping with the tight labor market with the release of the NFIB survey. And that is what to watch for on Tuesday.
Well, this increase in market volatility has many investors searching for stability in quality stocks. But which companies fall under that category? And what does this rotation mean for the broader market? Mike Santoli takes a look.
Investors are increasingly willing to pay up for quality in a turbulent market. Shares of high-quality companies began outperforming even before the broad market hit a rough patch starting in late September. Quality in this case means companies with stable businesses, not dependent on a strong economy, little debt, and strong cash flow. This preference can be seen in the likes of McDonald's, Walmart, Walt Disney, Starbucks, and Merck trading near record highs. Healthcare is the top performing sector for 2018, another example of investors rewarding steady, cash-rich companies. Quality stocks are not quite the same as value stocks, those cheaper-looking companies that frequently are geared tightly to economic growth rates and tend to carry a good deal of debt. Wall Street is increasingly preoccupied with just how much the economy and profit growth might trail off next year after a strong 2018, which makes sturdy brand name stocks more appealing. And with the Fed's interest rate increases making debt more expensive, investors want to bet on strong balance sheets. While the market's message is never perfectly clear or predictive, this kind of rotation toward quality is something that tends to occur later in an economic cycle as the market turns toward a tougher, more volatile path. Might this be the market's way of hunkering down to await a solid signal on whether U.S. growth will hold up in 2019? Perhaps an encouraging deal with China on trade or a more accommodative tone from the Fed could refresh investor appetites for riskier stocks. For now, though, quality is in style. For Nightly Business Report, I'm Mike Santoli.
So our next guest is here with some quality names that you may want to consider in this volatile market. Joining us tonight is Eric Marshall, President of Hodges Capital Management. Good to see you, Eric. Welcome back.
Good to be here.
You think we're about 2/3 of the way through this particular correction, so maybe don't go defensive, but definitely go to quality.
Yeah, it's hard to get defensive when we've seen the market correct as severely as it has. Well, no one knows where the bottom is. But I think this is the time where you're going to start to see new leadership emerge in the market. And, you know, recently, up over the last year or two, it's really been about a lot of those fast-growing companies that trade at very high multiples and carried with them a lot of momentum. We think you could see a rotation back into some of the more value areas of the market. So not only would we be focusing on quality companies, but also very focused on valuations here.
You give us 4 names. We don't have time to highlight all 4 of them necessarily, but they are FedEx, AGCO, Nordstrom's, and Cinemark. What's the common theme other than just quality? What is it you like about these companies?
Well, all 4 of those are areas of the market that have been kind of ignored and forgotten about. Transports, ag equipment, consumer names like retail and a movie theater company of all things.
Right.
And these are areas that have been ignored. They have very positive cash flow, they pay good dividends, and they trade at very reasonable multiples that we think have very limited downside from here.
How important is the dividend? I mean, in a market that's volatile, how would you rate it? Obviously, you want a good balance sheet in a company, a good brand, but how important is the dividend to you?
Well, I think the dividend does represent some stability in the company's cash flow because they have to generate cash flow to pay that dividend every quarter. But we do think that companies that have very stable earnings, stable cash flow, do pay dividends, and it could protect you on the downside.
And are these the kinds of companies you want to own even as interest rates rise? I mean, you know, the Fed is in the midst of the whole process of trying to normalize rates. So are these the kinds of companies you like in that environment?
Well, like I said, these are areas of the market that you haven't seen outpace a lot of the more higher growth areas of the market. They tend to be some of the more boring areas. And I think valuations are so compelling right now that even in higher interest rates, we may see the valuations of what the market's willing to pay for those earnings not go up anymore. But we still think these companies have the prospect to see further earnings growth next year.
Sometimes boring is good.
In a lot of these areas.
Eric, thank you very much. Eric Marshall with the Hodges Capital Management.
And before we go, it was one of those days again on Wall Street. The Dow fell by more than 600 points. The Nasdaq dropped more than 2%, and the S&P was down 54 points. Shares of Apple fell by 5%, pressuring the broader technology sector today.
Quite a day. That'll do it for us tonight. I'm Sue Herrera. Thanks for joining us.
I'm Bill Griffith. See you tomorrow.